Say you come across your first 1 million naira and you are looking for where to invest that money to bring about returns on investment. What will be your next line of action? Would you go on social media asking influencers for stock recommendations? Or would you call a friend to tell you where to put that money? This is how people end up buying investments that they don't actually understand. Now, in this video, I'm going to be giving you 6 mistakes that beginners can avoid before investing their money or committing their money in the stock market. So if you are meeting me for the first time, my name is Charles Ojefo, and on this channel, I teach people how to make, manage, and multiply their money. So give me a thumbs up and also subscribe to this channel for more videos like this so that YouTube will send you notifications whenever I drop videos like this. Now quickly, let's move to the first one. The first thing is that you should understand what you are buying. Now, you must not be an expert before you invest in stocks, but you must understand what you are buying. Now, what sector is that stock in? What sector is the company in? Is the company making profit or not? Who are the management of that company? Now, these are the things that you must check before investing in any assets. Now, recently we saw that First Bank started rising in price, and that was because Femi Otedola, which is their chairman, invested so much money in the stock, which also boosted investors' confidence in the stock. So the stock started rising in price. So a beginner that is seeing the stock, which is First Bank stock, rising in price so sharply, we want to invest in that stock without going deep into their fundamentals and their technical analysis to know if that stock is actually good to hold for if it is short term or the long term. So number one is that you must understand if the company is profitable or not. If the company is making, progressive assets, are they acquiring assets? Are the assets increasing or decreasing? If the asset is decreasing, it means that it is a bad company to buy. Their asset must be increasing year in, year out. And their equity must also increase year in, year out. That is the number one mistake that most beginner investors make before entering into any investment. Number two is that investing is different from trading. Many people come into the market with the idea that they want to invest today and quickly sell tomorrow. Now, that is called trading. When you put your money in an asset, you must understand what that asset is, what the stock is. You must have strategies to trade that stock. You must have skills to trade that stock. You must understand the company deeply for you to be able to understand if the stock is about to rise or not. You must know when the best time is to buy that stock and to sell that stock. That is what is called trading. But is trading in entirety, is it bad? No, it's not bad. But then you must understand the technicalities that goes with trading before you can trade in the stock market. But investing will require you to commit money into a particular asset for a longer time so that you can have compound effect on that your investment. So that is the difference between trading and investing. So you must have the requisite skill to trade before you can go into trading. Number three is that you must master your emotions. Now, it is easy when the market is bullish, and let's say you invested 2 million and you are having 2.5 million. You feel like a genius. You invested 2 million and you are having 3 million as your return on investment. It is sweet and everywhere is rosy, But then, when a 2 million investment reduces to 1.7, emotions such as fear, greed starts to play into it. Fear of missing out, FOMO, starts to come in. And you begin to doubt yourself. You begin to question yourself. So, fear of missing out and greed, these are emotions that have made beginners to sell investments, very good investments at discounted prices. So for you to actually profit in the stock market, you must master your emotions. You must master that emotion that, will tell you, your money is reducing. It is actually reducing on paper. It has not actually reduced if you don't sell. So we must master our emotions to be able to profit from stock market investing. The next point is create an emergency fund. Now, most beginners just want all their money to be working for them. So they make the mistake of putting all their eggs in one basket. They take all their money and put in stocks without creating an emergency fund. Now you can take 3 to 6 months of your living expenses and put it in a fund like a mutual money market mutual fund in case of emergency. For example, you lose your job and you want to feed your family for 3 months, 6 months. You have rent to pay, you have school fees to pay. Now, how do you get money? This is another place where most beginners sell their stocks. For example, let's say your stock is down 20% and you need money so badly. So if, for example, you had an emergency fund, you just reach out to that emergency fund, like your money market fund, and pull out that fund you need to settle that bill. But if you don't have an emergency fund in money market funds, what do? You go into your stock portfolio and sell your stocks. So when you sell your stocks, you might sell it at a cheap price, maybe when the market is down. So this is where most beginners make mistakes, not creating emergency fund. Another mistake that people make is thinking that investing in the stock market is a get rich quick scheme. That is why they want to put money today and tomorrow they want to sell and cash out. You understand? So investing in the stock market is not actually a place where you just, it's not a lottery. It's not a get rich quick scheme. It is a place of patience. You understand the company you are investing in, understand that you are investing into a business. Then you invest in it with patience and with compounding in your mind. When you reinvest your dividends, you reinvest your capital appreciation, and it keeps compounding over time. So that is what will make you to be profitable in the stock market. So this is one mistake that most newbie investors actually make. Now, the last point is that your income is your most important asset. Your income is your most important investment. Now, that income that gave you 1 million, 2 million, what if you can diversify your income streams? This is another way of thinking that newbie investors fail to think. If you can increase your income, let's say you make 150,000 naira every month, and you can create another income stream that can give you over 200,000 naira every month. That would be about 2.4 million naira every year. You understand? So you have created another income stream. So you think of how to improve yourself, how to get new skills, how to sell digital products, how to, diversify ways whereby you can earn so that you can increase your normal income stream to another stream of income. So by increasing your income stream, you will see that you will make more money and you have more money to save and to invest. So these are the few mistakes that most beginner investors make when investing in the stock market. So if you found this video helpful, give it a thumbs up and also subscribe to my channel so that whenever there is any video like this, YouTube will bring it to your notification. And if you want to join my investment training, kindly use the link in the description of this video to join my training. See you on the next one.